We have just been part of one of the greatest bull markets of all time, but could that be coming to an end as we enter into correction territory? Well, as it turns out, there is statistical history that backs up whether we're in a recession or we're going to be going into more good times. And what happens over the next coming days and weeks is going to matter hugely for all of us involved. In today's video, we take a look at the good news that's starting to occur and, of course, the things that we still need to see to confirm anything is about to rally. As it turns out, some of the biggest stocks in the world are still struggling. So join us as we cover stocks, commodities, and cryptos in everything that you need to know right now about markets. This one's not to be missed. We'll see you very soon. Well, welcome back everybody to The Daily Show. My name is Tom, and in today's video, we'll be talking about the latest macro data, dark pool analysis, and of course, the maximum pain for this month's Opex expiration, just 24 hours away. But more importantly than any of that, I want to say a big thank you to each and every one of you for subscribing and making this community one of the biggest and best on YouTube and social media. We just reached 200,000 subs, and if you haven't already subbed, make sure to do so. There's so much more to come. A big thank you to you guys, and it's been an amazing journey over the last 5 years. Let's start off, though, by talking about what we all love, which is, of course, markets and whether we are heading into a recession. Of course, recently, recession fears have spiked, and many people will know that when you get a recession fear spike, that can often be actually a buying opportunity. Generally, recessions come out of nowhere, and nobody expects them. Now, you may argue that's exactly where we're at, but as it turns out, markets will do a very specific thing in terms of either going towards the recessionary path or improving overall. And it all comes back down to exactly where we are right now, just under the 200-day moving average, and more importantly, in the correction phase, negative 10% on the stock market. If we continue to dial a little bit lower and then rally up, things are all good. But if things continue to slip away from us over the next coming weeks into maybe month, then we are probably going for a recession. And that's going to be quite scary indeed, as that if that blows the bubble and more importantly kind of really sets in stone some debt issues that we've been talking about, things could get serious. So in today's video, let's take a look at what things are happening right now that are positive and of course where the negatives may lie. We always want to be semi-balanced here whenever we're looking at this stuff and understand that both cases are open, although of course recession calls are statistically much harder to pull off. Let's now take a look at the corporate insider velocity. Is that looking positive? Well, as it turns out, during this dip, like a lot of dips to be real, the corporates are buying big time. And since the global financial crisis, they've generally been correct. Insiders are buying out of control, and this basically means that they believe that the market is probably seeing a little bit too much risk for what they think is coming. Now, this could be due to deregulation, or it could be due to corporate tax cuts on the future, or maybe even the speculation that the Fed has now done the Fed put and that the market is basically stabilized. But 1 week, 2 weeks, 1 month, and 2 months later, you can see the stats are fairly positive. And in all of these previous stats, if you looked at 3 months later, which is becoming a reoccurring theme whenever we look at this data, it's 100% positive, sometimes for some exceptional profit. Now, I don't think it's going to be like that one because, of course, that was 2020. But yeah, certainly is an important sign. Another one is CTAs. Now, commodity trade advisors, momentum funds, they've been basically thrashing the market recently and selling off. However, they've moved down to a point which is notoriously oversold for them. And you can see in recent days, they have been part of the buy the dip style market that we've seen, which has been a small rally upwards to 5,700, where we've found resistance and, of course, a huge amount of calls. Now, why is this important? Well, if they're instigating buying the tape and they're oversold as much as they have been recently, they will eventually have to buy back up. And as we know, we've entered a 2 sigma event according to Goldman Sachs, which basically means that we are looking at a point in time where markets are superiorly oversold and generally will have to be bought back. $45 billion plus needs to be instigated in buys over the next month, according to Goldman alone. We've got the data in that in a moment. Now, another big one has been the VIX. Now, as you guys know, the volatility market is a big one because if it spikes high and then starts to decline and then doesn't spike again, of course, that usually means the worst is behind us. Well, as it turns out, the VIX rose above the upper Bollinger Band, but last week crossed back below. And this is a big deal because whenever that's happened over the past 5 years, that is that basically we've seen that decline in the VIX, then we would usually see the S&P 500 be higher 86% of the time over the next 21 trade days. So that effectively means that even if we drop more, traditionally 86% of the time, it will be more bullish. It will actually get back above the price as of the last 24 hours. Now, that's from market charts. I think it's a pretty interesting stat alone. We're also seeing buy ratings being upgraded here across the board from the street. Whether you like it or not, people do use these. And if big institutions are saying, you know what, come buy our stocks, they're cheap, then yeah, a lot of family office money and other money will float into the markets. And you can see this is the highest buy rating we've had since actually the bottoming effect over back in 2022. Does that show you that maybe there's some more money coming in? Well, of course, along with this 2 sigma 1 month rally, we do have some good signs. So this is the 45 billion tape that needs to come in. We also know that there are certain puts being kind of escalated here in the markets ahead of the Opex. And if you take a look at all expirations here for the NASDAQ, we'll look at some others soon in terms of the S&P 500. You may notice a reoccurring event, 20,000. Yeah, it seems like every single person seems to be trying to put a put on that level. It's a big psychological zone. And that can act also as a buoy. So basically an area here, or buoy. And that is an area where you've got that big support and markets are not able to get below it. So effectively, it's kind of like a nice buy zone or a nice level that the market wants to gravitate back above before these expirations so they don't have to do payouts. Now, on top of all of this, we also have sell-offs. It doesn't matter which mag stock you look at, pretty much all of them are down. Of course, Tesla down the most, and we'll talk about that later on and what's going on there. But Nvidia, Microsoft, Amazon, Alphabet, Apple, Meta, all of these are down upwards of almost 20% at this stage. And that's entered into a period where we've traditionally seen dip buyers. Now, it doesn't mean they're there. I mean, of course, you can say, oh, well, what if it goes bad? Yes, of course, it could go bad. But you can see here, since 2019, if they're going to come in, that is, the buyers are going to come in, they generally come in over the next couple of 100 points, and they've already started to show some of those signs. There was a large dark pool, though, up at 5,700 we'll talk about. So there's clearly a bit of buying and selling going on. But even the rare oversold conditions of the rate of change, that started to move down to points where we've traditionally either seen false rallies that have done okay or bottoming style markets. Now, of course, most of you are hoping, I'm sure, for the bottom. Some of you in the comment section want this thing to absolutely get smashed. But just remember, it's all about 2 steps down, 1 step back. Now, what about the Fed put? Well, FundStrat's Tom Lee obviously going with the positive side here, as always, which is that he believes the Fed put is in play after the FOMC press conference. To some degree, of course, we already said this before seeing this particular report. And the reason why is because basically QT was ending. Effectively, they've announced that QT is ending. Yes, it's not completely done yet, but that's going to be in play. And of course, in general, we do know that we've seen a waterfall style decline, which is effectively where you see a market that just drops at such a quick pace, the 5th highest ever recorded, as you guys know. And that is very, very bad. Sentiment also shocking, everything else shocking. Traditionally, when fear or blood is in the street, you want to be looking a little bit more positively. Now, does that mean it's going to go to an all-time high? That will be determined by a few points in price action that we'll be seeing very, very soon if it does recover. But do remember, 2 steps down, 1 step back is usually a good sign. So that's why things like the golden pocket, the Fibonacci level of the 61.8, is such a popular one, because even on the way up, what you'll have to notice in the smaller timeframes is it'll go up like this, drop like this, go up like this, drop like this. That's a nice, healthy technical market. And on the downside, it does something very similar. Now, we did see some big breadth stats the other day, which was 2 85% plus breadth stats. Does that usually mean that the markets are positive? Well, again, yes, 2 months later, not a bad read. We do often see sometimes a new low being formed, though, which is, I think, a very important stat that we've talked about. But in general, again, it's pointing towards this being a fearful sell that could be bottoming off. And you can see here the previous times that's happened after hitting an all-time high and then selling upwards of 8 to 10%. Core risk models, of course, we've already shown that they've been ticking up recently. And the 5th fastest sell-off ever equal with the Volcker shock and the Asian financial crisis. Again, 3-month stat, very, very bullish. You can always say these times are different, but we already know one thing. The way this market structures up over the next coming days and weeks is going to matter. We keep making new lows. We go down to 15% taken off the markets, and we're doing that, let's say April, May. Oh, not good. Not good at all. And those stats will really point towards much, much worse selling, I think, in the future. Now let's go to the other markets around the world that we've been watching in terms of the metals markets and also some other indices. We will go to dark pools in just a moment. First up, silver seasonality. Are there more legs left in silver? Well, traditionally, silver has one of its best periods of time moving forward. Now, I'm sure a lot of people are already doing this. Of course, we've been bullish on silver now for quite a while, but we are seeing on X or Twitter, silver is due to explode. Everyone's making YouTube videos on it and everyone's talking about gold. Look, I never like it when everybody likes something, of course, but you can see here that seasonality is still in that case, and silver's come down to a very important level for it to bounce. We also know China exceptionalism and Germany exceptionalism seems to be the kind of theory in the markets at this stage, although we do think that China's hit a temporary resistance, and you'll see why in just a moment. Big dark pool coming through on a bear fund. Now let's move over here to what's been going on. As we mentioned, there were a few sneaky sells at 5,700 right in the close. A lot of them came after hours actually, and that was at 5,700 effectively for the S&P 500. Huge sells coming in. We dumped down post that event, and then of course we've recovered back up to it. So we know where they're selling, which is 57, and we know where they've kind of been trying to buy, which is like 56.20. So we're stuck in a range ahead of the Opex. We'll look at max pain in a moment and you'll be surprised where that's at. But probably no real clear path there other than we have these cluster low trades, which I always like because these clusters tend to usually lead through. So even over here, you can see there was a new low formed, but it ultimately came to a new high. So clusters do matter, and I like what I see here, and I'm sure a lot of you guys do if you're bullish. Now, we mentioned before there is a bearish signal out there, and that's for, of course, Chinese stocks. They hit almost 25K on the HSI, which is a great level. Then we've seen a monster transaction come through there, third largest dark pool ever, and this is on the 3x levered sell-off. So that doesn't mean it's over and everything's going to go bad, but it does explain why we ended up seeing that sell. And of course, it explains that there could be further consolidation, downside action, at least for now in China, although we are still bullish on those stocks. So 25K or around there, of course, was our TP zone for traders. And we still think there's more in it for an investor if you're willing to think about it on a month-to-month, year-to-year style basis. Let's now move over to dark pools, or actually transactions, more importantly, that are going through on the crypto markets. Bitcoin, another day of positivity, taking us to a net gain, and Ethereum still floundering with net outflows at this stage. Sector rotation in the markets was kind of, I would say, a mixture of defensive over the last 24 hours. Utilities, healthcare, energy continues to be a real standout over the recent couple of days. And we also saw financials holding their own. That's a good sign. Financials have spiked off their lows, now effectively making this type of candle a hammer. That's a good sign. Technology was out of focus. And you'll see the last 5 days, financials are now the second best market. So gold slowed down here after all of the fever on that. And we've actually moved to basically financials being the second. Now have a look at this. Of the major indices, only one's down, biotech. Actually, the last 5 days, positive across the board. That 55.50 level that we were talking about has turned out to be pretty good. Now let's move over to max pain. It's been a while since we brought this up, and there are reasons it's not working as well post the 0 DTE kind of expiries, because of course it used to be that it was just a once weekly expiration and there was more hedging that used to go on around this. But you will notice that technically the most struck level is 580. You can see here the puts and where they're sitting, 560, 550, 570. All of the 100-point increments are the key. And really, you would probably expect the market to be between 560 and 575 when it comes to expiration. So that would make sense. In fact, it's the market's slightly skewed towards pushing higher into max pain, whatever that means, we'll take with it. Now let's move over to the S&P 500. Of course, that reset, but anyway, that's all right. We'll show it here. Now, structure will be everything. 10% down, how is this going to structure? So why this is important is because when we look at what's going on here in the markets, there are key levels that will be coming up if we do see that kind of 2 steps down, 1 step back. Now, this is effectively the price that will ultimately be a decider. But remember, if this market keeps taking lower lows, we clear through 5,400, which opens up, horror show 5,200 style scenarios. If you're doing that, you're effectively saying to the market, we're in a recession, or we're entering a recession. Now, you might say, well, that's very good. We're already down 15% at that point. But remember, I'm not of the opinion that it's going to be a soft landing. Everything's going to be fantastic if we go into a recession again after just going into a technical bear market a few years ago. I'm of the opinion it'll be much worse. So could this be the start of something really shocking? Yes, it is possible. Of course, you've got those telltale Wyckoff style signs, which again, usually show a recovery first. But the problem is that generally speaking, when you're talking about a recession, it's usually something that you cannot fix. That is, it's something that's really sick in the economy. Remember, we went from being an incredible economy. Everything was looking great. And then suddenly now it's not looking so great. Why is that? Arguably tariffs, arguably some other things that are going on geopolitically. And of course, we haven't got those things that the market wants, which is corporate tax cuts and deregulation. So some things can fix this, including the Federal Reserve just basically saying, oh, QE's back, guys. So I think it's very important to note that if there are structural things that are starting to look towards the recession curve, which could force algos to keep going, there are, let's say, almost Ponzi style things that are coming into the markets that could allow the markets to go back up. So I think it's a catch-22 here. I would still be more optimistic than pessimistic, although some things have been dropping. And you'll see that when we look through some of our leads in a moment. Let's have a look at the options high and low levels today. You can see the wicks here and the indecision coming into the Opex expiration. The most important level is probably still 57.57, which ultimately is around the 20-day moving average. And also, if I had the 200 on here, which I don't today, but if I do, 200 simple, sitting right on that same level. So a lot of stuff going on there, plus supply. I do expect to at least touch the 200 at some point. If markets go like this, that is actually very strong, in my opinion, towards a full-fledged recovery. If markets do this, it becomes much harder to read. So we will be watching this incredibly closely. Why? Long leg doji showing some things. I'm actually looking at the mags more than anything else right now, and you'll see why. Because if the Magnificent 7 is able to break through some of these key points, I think it's a huge bullish sign. Now, let's go over to the options for the expiration. 56, 55 seems to be the whole level in terms of puts. Of course, negative gamma taking hold again in these markets. 57, 56, 55, all these things. Tons of options expiration. Remember, it's quad witching, which means you don't just have traditional options. You've got single stock options, index options, etc., etc. And this is important because when you have this much expiring, it can create a little bit of up and down. Generally, the Thursday, which we just saw, and it's today in the US, is the one that's more volatile. But we'll find out. 56, 55, certainly important to check out here. Now, when it comes to the other markets, such as something like Tesla, for example, you guys know it's stuck between 240, 250, and 220. And I just think it's stuck in a range. Until that gets out of that range, it's really just like buy, sell, buy, sell, buy, sell if you wish to trade it. Otherwise, no real trend has been set. But I always love laughing at this. I mean, who is this person? These people are just getting smoked with their $950 calls on Tesla. I mean, they've been getting smoked for a while now. We first noticed that a little while ago. It's absolutely ridiculous. Good luck to them, I guess. Now let's move over here to NVIDIA and see these levels. Yes, we've got the 118. We're trading around that. We know 115's the most traded zone. It keeps accumulating, or something's going on here. This is a heavily traded zone. Through 120, 125, particularly 125, 126, as we mentioned at the start of the week, we back enter into positive gamma, and we're hoping that does happen. There are some positive signs in a couple of tech stocks we'll look at in a moment. Let's go over to what's going on in the world of everything to do with bonds, and you can see here that bonds have dropped a little bit in terms of their freak out recently. That's a good sign. Again, that can mark bottoms in markets. We go over to home builders. You guys can see here, good level to look at for some bullish strength will be a break of this daily 20 moving average. Pretty much the last 2 months, it's just been consistently selling that area. Again, hitting it and selling it last 24 hours. Would like to break that, break the downward trend line. Could be a good sign that things are starting to improve. So far, we are not seeing that. And treasuries just floating around. A couple of large dark pools came in here, still determining whether they're buys or sells. Could be a sell, we'll find out. Yields, of course, stabilizing after dropping in the previous session. So you can see here again, stabilizing. Do remember, if yields also manage to break below these levels, such as 4.1, that's a pretty significant switch in what is currently 3 wicks to the upside. So that at the moment, it kind of looks like it's trying to find maybe even higher levels here as people start to fear stagflation or inflation again. US dollar, therefore, consolidating. It is oversold at this point. We still think it's going to sell this year. But in general, I would still expect this. I would not trade based on that, though. I think it's not worth it. Risk reward doesn't make sense. What about gold? Starting to get exhausted. So we love gold. Don't get me wrong. We love gold. But I have explained, and we've talked about this before, 3,000 is a tough number. Why? Because the doubles, it's a massive $1,000 increment. So whenever you get to these increments, 2,000 was also tough. It blew through 2,000, sold off, blew through, sold off. Some exhaustion signs starting to show here. Haven't seen full exhaustion like we saw on silver, which is pulling back at this stage, but doesn't mean it has to go crashing. It just means a little bit of sideways action is due. Now on silver, I do like what we've seen traditionally with a longer term perspective. That is, it drops down, hits maybe this daily 20, maybe we see a day trade style buy there, and we start to move up. Remember, if we're able to close above these levels and really push in, we could be going quite a lot higher on silver. And I am excited for silver this year. And in fact, a lot of metals. I mean, look at copper. If you guys haven't seen copper recently, look at this. This thing is ballistic. I mean, yeah, okay, it's getting exhausted, but my goodness, it's ballistic. It's still going. And this thing's absolutely becoming the talk of the town for a lot of people. It's boring. Most people don't like copper, but copper is absolutely just smashing it. And we've talked about it a couple of times now. US oil starting to look interesting. This is a tweezer style sell. And then all of a sudden it comes up with the bullishness. I'm telling you what, it looks like it's going to break out this high. And that's going to catch a lot of people off guard on the shorts. Remember, this is a critical level for oil. And I think 65 a barrel is break even for some oil refineries. So basically, we have a very critical point for oil. And yeah, again, day traders could be there. Now let's talk about the mags. Rejection off the lows. We'll see how this ends. Look at the volumes, big volumes. And we go down to the smaller time frames. Look at this daily. 2 rejections off the resistance up here. So what we're looking for is we're looking for a break of 48 on the mags. Why is that important? The once leaders need to play catch up. Why? They're too much of the S&P. The top 10 stocks or something is like 37% of the S&P, or was that high. I mean, how are the S&P going to move if it's not getting these stocks? The actual internals don't look too bad in terms of the other subsections of the S&P, but these ones look horrible at this stage. So we need to break up. We are at the right area. We're at the area of demand. It has to find buyers. We need to get through 48. So 48, 48, 48 on the mags, important to watch. Tesla, similar thing. It is totally oversold on the markets. Obviously, one of the fastest crashes of all time, market cap wise, and maybe the fastest. And we can see here that it's getting into all sorts of bias and people having very polarized opinions on it. Ultimately, we know it's 220 where the puts are, 250, 240 where the calls are, and it's just kind of like this at this stage. So we'll keep looking at it, and we will figure out what's going on there. Now, NVIDIA, same type of thing, most traded zone, most traded zone, most traded zone, still has positive price action on smaller time frames. So still positive there. And I'm actually liking AMD. We've talked about AMD here recently. The tweezer on the bottom, the really nice recovery. I will say, though, this downward trend line is exceptionally interesting to me because you can see here for the first time, AMD actually broke above. Now, this is the trend line that's gone through since December of last year. You can see it's a very aggressive sell that traditionally has happened here. Now, this is the first breakout above that. Weekly close coming up soon. Very interesting indeed. I'll be looking for some dark pools in there. I haven't actually done the research on that bit yet. US 2K, what have we done here? Nothing much. We've slowly ground higher. Actually doing okay, US 2K, but structure is, I think, quite difficult to read. Maybe a 2110 break will be good. NASDAQ, also improvements, but continuously sells off the highs. A lot of you guys trying to sell. I do see a lot of people saying, sell every rip. It's relevant. Of course, if you are looking at trend, you may be thinking that, but do remember it's not as simple to sell every rip now that we have seen some recovery signs in comparison to where there was no recovery. There were no recovery signs. It was just continuously selling the 5-day EMA. So that's what we did have. We broke above that. We are stabilizing, but yeah, we need to probably close above 20,000. Why? Well, we saw it. It's a put zone. It's a huge put zone. So 20,000 matters, guys. That's a big level. Let's now move over to Ethereum. You guys can see here, most traded zone on the way up is 2,200. I think until we regain past that, we really haven't done anything to improve structure. So that's kind of the Ethereum story at this point. And Bitcoin is starting to lead a little bit, 85, 84.8. This is a good level for it to hold. Obviously needs to kind of get through these 95s to really get a swing trader or an investor in. Still very diabolical out there in the crypto markets. There's almost no bulls left in terms of people are really negative on it. But that's how it always is in the crypto markets. So we are watching very closely. Bitcoin better than it was last week. Will it continue to improve? At the moment, small time frame say yes. High time frame says hell no. It says no, it's not going to improve. And the main reason is because, of course, we still continuously are seeing weakness across a lot of these moving averages, anchored VWAPs, etc. We'll keep watching, and we do have at least those flows coming back in together. If you enjoyed today's video, then remember to subscribe, guys. Also, check out our courses if you're interested to over at fxevolution.com or the pinned comment down below. And do remember as well to follow us on several of our platforms. I want to say a huge thank you again. 200K. What amazing people you guys are. And to get us to this level is something I thought we'd never do. So 100,000 was phenomenal. 200,000, making it pretty much possibly one of the largest daily shows that covers data in the world. Maybe we are the largest. I don't know. Thank you so much, guys. We really appreciate it. We'll see you very soon. Bye for now.